Welcome to the Brain Pick a Pro Show, live from Lake Wiley, South Carolina. Today, I have a special guest, a long time friend, known him for many years, probably 10 or 15 years, something like that. This guy is the self-storage expert, right? Now, he's done residential, he's done multifamily, he's done other stuff. He's a speaker, educator, trainer, coach, mentor, but his specialty is self-storage. And I'm so excited he's on because I've had a lot of people ask about self-storage, and I don't do everything. I don't claim to do everything or know everything. So I like to bring on experts. So today, expert is Scott Meyers. What's going on, buddy?
Larry, all kinds of things are going on. How about over on your end?
We're just having fun and making money, trying to stay focused. You and
I
both know that can be difficult sometimes, right?
Yes, we do.
Right. We were just talking before we started recording about ADD, ADHD, and I have what's called ADOS, attention deficit. Ooh, shiny.
Yeah, and, full-blown ADHD diagnosed early on, but as you know from many entrepreneurs that you probably have on this show and that we know, a vast amount of them have some degree of it or not, or whether it's officially diagnosed or not. I think those of us that do want to move forward and move forward fast, we end up in our own business because at the end of the day, we usually can't work for somebody else. They don't want us there.
They don't want us there is probably the most important part, right?
Yeah.
So before we started recording, I shared a book with you. I want to share it with the audience because I know that a lot of entrepreneurs out there, and I just started listening to this today. I use Audible, and I love Audible, Scott. I love it. You can listen to a book at 1.5 or 2 times speed.
Yep.
A 4-hour book you can knock out in a couple of hours. And this book is called Faster Than Normal. Turbocharge your focus, productivity, and success with the secrets of the ADHD brain. And it's a phenomenal book. It's a phenomenal. So far, I'm only about a third of the way through it, but it's really, really good. And, and it makes me know that, I'm special, but
yes, we are.
Right. We're special, but there's nothing wrong with us, right? It's just we think different, right? So, Scott, that's enough of that. Why don't you jump in and tell our listeners a little bit about yourself?
Sure. Well, I live in Indianapolis, actually a suburb of Indianapolis called Fishers, Indiana. I've lived here since I graduated from college, moved down here. And once I got a job and actually making a little bit of extra money to begin to plan for retirement, I started getting into real estate as well. So doing all the same things, stocks, bonds, mutual funds, maxing out my 401k and my employer. But then started doing real estate on the side. And I kind of always been a junker at heart. I used to fix up bikes when I was a kid and then cars. And I thought, well, this is a natural next progressive step. So I started buying houses and fixing them up and refinancing them and pulling out cash and buying more and renting them out and following the Carl Sheets method. And so we began doing that until it wasn't any fun anymore, having tenants and toilets. And I thought, all right, well, I'll get into apartments. At least I can hire a property manager or a property management company to handle all this. And once I get into apartments, I realized, I didn't really like that too much more because at the end of the day, the responsibility was on me and I had to write the check for the damages and everything else. And so began looking into, other ways to invest in real estate that didn't have tenants and toilets and trash. And there's parking lots or there was self-storage. And you can't really build a lot of value in a parking lot, but you certainly can with self-storage. And so the more I dug into it and learned about it, I got my first self-storage facility and then really saw the light. Where if people don't pay you, you basically lock their stuff up and sell it off if they still don't pay, whether they move out on their own or if we have to hold an auction. What I'm left with is a steel box on a concrete slab. And I don't have to do paint or carpet or anything else. I don't have to chase people for money for evictions because we already got our money. And so, for all those reasons, our motto or our tagline around here is that, we love real estate because it doesn't have the hassles of tenants and toilets and trash for what we're doing. And so then, we started teaching other people how to do this. I was the president of the local RIA, the Central Indiana Real Estate Investors Association, doing some workshops. And then a good friend of ours, Larry, Mr. Paul Bauer, helped me to actually, he contacted me. He said, hey, I've seen what you're doing. I've heard what you're doing. And, I think you can go out and teach some other folks how to do this. I'll get you out there and help you to write a course and assist people. And so he did that. And I'm not sure whether to thank him or not, Larry, because it's been great. I love to teach people. But boy, that kept me on the road and really took away from the investment side of the business. So we continue to grow it, however, and the two businesses were kind of going in tandem until about 2014. Drew a line in the sand and said, hey, if I want to focus on my investments and if I want to spend time with my kiddos as they're getting older, I'm going to have to shed one of these businesses or figure out a way to revamp them. And so that's what we did. We basically slowed things down on the education side. We increased our prices, which really eliminated a lot of the folks that we didn't really want to work with anyways.
Right.
And now we're working with high caliber folks that we partner on their facilities that we help them to get into with. And so it scratches both itches, my desire and my love to teach people, but also now I'm teaching people that are going to eventually become my partners. And so the investment side doesn't suffer. It actually, now we're leveraging up on that end. So in a nutshell, that's about the past 15 years since you and I have known each other and how we got to this point.
That's awesome. I love that whole strategy, that whole model about partnering, and you're getting people that have the right mindset, that have the right, they're teachable, they want to learn, plus they have the resources, right? Because it's pay to play.
Yeah.
Right?
Absolutely.
That's great. So tell us a little bit about, I know you've mentioned a couple of times, no toilets and termites and all that stuff. It's a concrete slab in a metal box, right?
Yep.
One of the things that I've always had a question about is self-storage really an investment or is it a business?
Yeah, good question. Good question. So we look at it a couple of different ways. It's interesting you mentioned it or ask it that way because one of the beauties of the business is in where we find these, how we go out and do our shotgun approach to marketing to find them. So we look in the traditional real estate, areas, talking to the brokers, looking on LoopNet, a number of other ways in traditional real estate from where an investor would look for, commercial properties of any sorts. But if you put 100 self-storage owner operators, the mom and pops that we buy from in a room, you ask them, how many of you are in a business right now or consider self-storage a business? 50% of them would raise their hand. And how many of you would say you're in commercial real estate? And the other 50% would raise their hand, roughly. And then you ask them, how many of you say you're in both? Well, 100% of them would. So yeah, it has a retail, it has a business component to it. Right. Because we set up shop. We don't. It's not like if you own one single family house and it goes vacant, you put an ad on Craigslist. When we facility, it's got 200 to 400 units. There's always people moving out and people moving back in. So, we set up shop. We have an office with a person working behind the desk that's answering calls all day, and we have a website that is allows them they can rent a unit online as well, which is a beautiful thing, or they can make a reservation and come in and complete that transaction as well. So, that property manager, like an apartment complex, they still handle the accounts receivable and they work with the folks when they come in. The only difference is that they just don't have a lot of problems. They're not handling arguments between two tenants or somebody parking on the lawn or what have you. They're just handling the basic transaction: move in, move out, collect money. So it is. It's a business, and for that reason, Larry, we also we're seeing at least within the past 10 to 12 years. Self-storage has really kind of come into the limelight, and it's coming to Main Street. So no longer can you build them and they will come in the middle of a farm field or in an industrial sector or part of town. You're seeing self-storage competing for that same piece of dirt on a main road next to Walmart and across from McDonald's and in the path of travels where everybody goes. It's become, a very integral piece of our lives. And we're even seeing the city planners now including self-storage in their master plan. When they plot out a development of a certain part of town or as it's expanding, you're seeing self-storage included in that as well. So I think that answers your question. I forgot what the question is now.
No, that's okay. Just, is it a business or is it an investment? Yeah. And that's a really, really good point. It's, where like if you own a lot of single family houses, that's an investment, but you've got somebody in accounting, you've got a CPA, you've got a property manager. So it's really not a whole lot difference other than your person is on site, right?
Yeah. Right, right. And then we do, as we scale, there may be a bookkeeper behind the scenes, and as we have that support staff, but looking at just one self-storage facility, whether it's a manager or a management company, yeah, they're handling everything, at that site level. And the good news is that then it becomes an investment because it is hands off.
Right.
There just isn't, the hassles of the tenants and the toilets and the trash to take care of from that standpoint, which, I know you and I have talked about this before, both big fans of Michael Gerber and the E-Myth, and, the systems run the business and we manage
Right.
and tweak the system. And the good news is that, the system really does run the self-storage business because we take out a lot of that human factor and the headaches that go along with it in this form of rental real estate.
That's so true. And in a few minutes, I want to talk about some of those systems because with self-storage especially, there's a lot of really cool things that you can do to where you can really run a facility to a certain extent without anybody on site. And that's really, really cool. But first, I want you to tell us a little bit about the model. Is the self-storage model that you do, and maybe you can touch on different models, is it buy and hold long-term, buy, increase the value, sell it, that sort of thing?
Yeah, but anything we do is value add. That's how you build your safety net and your buffer. I mean, no different than houses. When we're buying houses, we're buying the distressed stuff, because that's how you make your money, obviously. But it's also how you don't lose money is if you buy it right.
Sure.
But with self storage, that was our model in the beginning. Was really kind of stepping stone from where we'd come with houses and apartments. Except the value add is not necessarily making it prettier, although that's a component of it. It's raising the net operating income, so increasing the income, reducing expenses. And so our model in the beginning was to buy and hold. So find a facility that was underperforming, tired mom and pop, that took their eyes off, the wheel, so to speak, and they weren't up on technology, and I love it, Larry, when we walk into these mom and pop facilities or meet with them. They say, well, we're full, and I said, really? You're doing a great job. How'd you manage that? Well, we never raised our prices and haven't in 20 years. And first of all, I'm thinking that's fantastic because we already know, even if it's full, we think there's no value add to it. But then we look at the rents and they're $20 a unit below everybody else times 400. Well, they're boom. Already we're in the money the minute that we take over. So it's buying the distress that, have low occupancy where the rates are low, where they don't add in or haven't added in all the profit centers like selling locks, boxes, and moving supplies and truck rental and all the other profit centers that you can add to a facility. So you can't raise rates, and it's exposure is much better, including pictures for your website, if you have that curb appeal and the place looks nice. But that only goes so far when you were talking about investment real estate and something whose value is created on increasing the NOI. So we also look for facilities that we could add on to as well. So we look at a facility that's 4 acres and it has 4 buildings on 3 acres. Well, then we know that once we fill this up, we can build another building. And that's usually no money down, construction loan from a bank to add that. And then we start leasing it up and it's nothing but increasing the income. And we got the dirt for free. We got the land for free.
Right.
So that was the business model in the beginning. Always value add, always taking a Class C facility to a B. Adding security, adding the technology that's available to us today, and then just running it better, running it like a business instead of like a hobby.
Right.
And so those we look to buy and hold long term, but then we realize that we've been through a couple of economic cycles now, and understanding the difference when cap rates come down, interest rates are low, cap rates come down, which means the value of our facility is worth even more because the cost of capital is cheaper. And so selling at the top when we've already created all this value and taken those profits off the table and then doubling down and buying another one, a bigger one, 2 more, and doing that over and over again, really falling into kind of a 5-year cycle, Larry, on a lot of these, sometimes 3, and turning them around. But the good news is that we enjoy some big cash flow. And those $500,000 to $2 to $3 to $4 million checks on the back end are kind of nice as well. And then we started looking at development and conversion. So buying, you name it, old warehouses, bowling alleys, old retail and grocery stores, and converting them to self-storage, and then just buying plots of land, getting it zoned, and then developing. We're doing a multi-story climate control in different parts of the country. We got multiple projects going on right now with our student partners in Denver, in Detroit, in Tampa, in I'm trying to think of where else. Minnesota, one here and two here in Indianapolis, local.
Right.
And with, again, same 5-year projection on most of those. But now that 5-year projection is based upon our private equity, our private equity investors that we're bringing in. They only want to tie their money up for 5 years. That's usually the amount of time in which we raise that value and get to the peak,
Right.
at which, again, we'll exit and take those profits off the table. And so I am coming to an end on this. So we'll continue to do that until I run out of energy and out of breath in my lungs. And then maybe the last 3, 4, 5 will hold for then long-term, meaning long-term until they put me in a home somewhere. So that's the plan for the empire right now.
That's awesome. That is really good. I love that. So it's very similar to some of the other value add type commercial investments like multifamily or whatever. You're going to hold it, 3 to 5 to 7, ideal, probably 5 years. And then you're going to cash out all your investors and yourself and roll that into the next deal.
Absolutely. That's the plan.
That's awesome. Can you run through what a typical deal might look like? I mean, when you coach your students and you're buying deals, looking at deals, is there like a minimum number of units, maximum number of units, a value, a price that you're looking for? Kind of run us through that deal and how it's structured.
Yeah. So a number of factors that we look at. Again, we're not just looking at, taking like a house and making it the prettiest in the neighborhood. We know if it's the prettiest that it's going to get this amount of money, in an appraisal and the value.
Right.
And we're looking to where we can take this thing in an exit strategy and sell it.
Right.
So we look at if it's an existing facility, we look at where it's at right now, rental rates, cost to structure, where can we take this thing at 85% occupancy, and given the market rate right now, here's my gross potential rental income. So here's the top. If I add in retail sales and selling locks, boxes, and moving supplies and putting in moving trucks, here's my income, where we can take this. That's the potential. Then I look at the expenses currently. Can I reduce the property taxes by structuring a sale where I am buying the business separately from the real estate and then appealing the taxes on the real estate? Can I reduce the management by adding technology, like you mentioned earlier, by replacing a full-time employee with a part-time employee and then having a website that does the rentals and or a kiosk that also does this like a red box, and all down the line, putting LED lights in, where can I reduce all of my expenses and, coming to a number, here's my net operating income. Now compare that to where it is right now. What I'm usually looking for is about a 2x return within that time frame, a 3 to 5 year time frame. So if I buy it for $500,000, I want to be selling it for $1.5 million or $1.7 million if I had to put $200,000 into it. So I net $1 million on that. I'm looking for a 2x. Return on that, and that's the same for our deals in which we're partnering with bringing in private equity. We have to have somewhere around that, at least a 2x return, in order for them to get the internal rate of return that they desire for investing with us on a project. And then there's enough money left on the table that we're satisfied with that if we're bringing those folks in. So that's from a number standpoint, that's how we back into it. And obviously, if you don't have to bring private equity investors in, then you can do with less than a 2x return because you enjoy cash flow and you're fine with that. But we also, in terms of size, as you mentioned, and this is going to vary for everyone. I mean, some people are happy coming into what we consider a small facility, which is 50, 60 units. And I say small because it is in terms of numbers and size, and it doesn't require a lot of work. However, the challenge with that is that it does require some work for the owner because it won't be able to support a part-time manager. You can use a kiosk. You can use a website that is a responsive website that's interactive to allow them to rent units. But that only goes so far. You're still going to have to do some of that management on your own. Right. So, which again is great. We're just not at that level where we want any involvement. So we want to have facilities that are baseline, bottom line, usually 200 units and above. And at 200 units and above, it's really a function of the NOI to support a manager. But right around that 200 unit mark is where, Larry, we can put in a third-party property management company to then run it for us. And then we're just guiding them. We're providing the vision, folding it into our brand and giving them, an idea of what we want to do with it. But at the end of the day, they take it, run with it. They're the ones that move the needle. And we're not involved in the day-to-day operations. So
that's really good. So you just mentioned something I wasn't aware of. You mentioned about bringing in a property management company. I didn't realize there were property management companies for self-storage. I just thought, every self-storage owner hired their employee.
Yeah, a lot on the small end and the mom and pops that we buy from, yeah, that's the case. They've been running it themselves, or their sister-in-law or whoever in the family's out of a job. They
Right.
stick them behind the
Yeah. Right. That's
counter.
why they're wanting to sell.
Exactly. I love that, because then we can look at the payroll and say, "Woo, that's way too high." And yeah, there's lots of opportunities there. But yeah, you'll see that on the smaller end, that either the owner has to do it, or they're going to have somebody as an employee, because a management company, as there's overhead that's involved in that, and so
Sure.
there has to be a sizable amount of dollars allocated as a percentage to the managers and payroll in order to do that. And so yeah,
Right.
the big folks that we see out there, the public storage, the extra space, the U store at the life storage, those, not all of those stores, those storage facilities that you see are corporate owned. Many of those, a developer like myself has come and built it. And then, somewhere 3 months towards the end, we decide which one of those companies we're going to have manage it. And then the sign goes up. And then all the branding goes on, even though it's ours and they're managing it.
Right.
And then there's also small third-party property management companies that don't have a big brand that own, but that run these just like you would hire for an apartment management company, or even like some HOAs. They operate in that fashion, and they will come down into the smaller size facilities because they're smaller as well and don't have many layers. But they understand the business, and they do only self-storage management. And so we work with about 3 to 4 of those companies, and they're usually regional. But we use about 3 to 4 of those companies nationwide at our facilities, depending upon location.
That's great. That's really good. I'm in a small town, Lake Wiley, South Carolina. It's not even incorporated, right? The closest town is Clover, which is incorporated, and we have 4 self-storage facilities here locally. We have public storage. We had Kodiak, but I think public bought them out, so they have yeah. But and then we have 2 other independent storage facilities right here in Lake Wiley. And I actually went and visited all 4 of them recently, to kind of look at them, see what's going on, check them out. And also, I mean, we own our office building, so we're always leasing office space. So I left some brochures for our office space because I even asked them, do you ever get people that come in and are asking to lease office space, because, just kind of goes to reason that people who are moving or whatever, they might need some space. So, yeah, all the time. So I left them some brochures for our office space. But it amazed me all the different add-ons. And you mentioned a couple of them earlier. It amazed me all the add-ons and upsells and things like that. Talk a little bit about that.
Yeah, so that was again another one of the reasons why I like self-storage over apartments is that there's ancillary income streams and profit centers you can add to apartment complexes. You start by submetering the utilities, laundry, vending, and there's a few others, but it really stops at about a handful. But in self-storage, when I began looking in the industry, there's over 40 different profit centers that we can add on. So, I mean, just right at move-in, again, the locks, boxes, moving supplies, moisture-resistant canisters, our admin fees, believe it or not, are income because we don't take a deposit. I mean, there's no reason to take a deposit. There's not going to be any damage. It's a metal box on a concrete slab. So,
Right.
It's a non-refundable admin fee of $19 when they move in. So that's a profit center in itself on every rental. We offer renter's insurance. We don't sell it because we're not licensed to sell insurance, but we offer that. And in some cases, we're seeing throughout the self-storage landscape, the big guys, the REITs are demanding it. They're saying you have to have insurance, renter's insurance, or you can't rent a unit here.
Right.
And so, by the way, here's who we recommend. And then they get a kickback for that, or even some of the big operators, it's their own insurance company. So that is an income stream generator. We do have vending machines. We have sometimes a business center that is available, like you said, for people to maybe do a little bit of work out of, so that they don't have to work off the kitchen table or out of their truck or out of Starbucks.
Right.
And then in some cases, our facilities, we are building out and using a co-working space or like a WeWork type spaces in these locations as well. You can add propane refueling. When you start adding boats and RVs, you can start adding other amenities to those buildings and closing them and adding electric and water, an upcharge for each one of those along the way. We're seeing concierge services now. I mean, yeah, the list goes on and on and on about those
Wow.
income streams and profit centers. So again, building value in self-storage is based upon the NOI. And so anytime you can continue to increase that, that's going to increase the value. We do record storage and then shredding services. So after 7 years, after the HIPAA guidelines are, met, we charge them to shred it by the pound as well. Medical records and delivery services and scanning and emailing, pack and ship centers, eBay for when the manager is sitting in there with idle hands. We can eBay some of those folks' goods, and we have a lot of eBay and Amazon drop shippers that our manager can walk over to the pack and ship center in our office and then charge them for that package service if they're too busy. So
Right.
Again, the list goes on and on. I mean, you can virtually get your property manager, the site manager, her salary is either paid for, covered, or at least subsidized by some of these other income streams because they're just sitting there for the most time. It's not that busy in a self-storage office as compared to other types of property management.
I love that. And I'm sure at this point you've got it down like salaries or employee costs. You probably know how much per door you can spend on salaries. How do you calculate and know how much that is? Is it per door or per unit?
It's a percentage of effective gross income.
Oh, okay.
We allot a certain percentage of that because, when we're breaking this down and looking, we underwrite it just the way public storage would underwrite a facility if they're going to buy it from us, which we hope. I mean, we're building these things up to be the size that we will sell eventually to these folks. And so we underwrite the way that they do. We underwrite the way that a banker does to get it funded to begin with. And so there's some market norms and some percentages. And so if we've got a 400 unit facility and it's bringing in $280,000 a year, here's the effective gross. We know that we can allot 5% towards the management company to oversee it. And then payroll is going to be X number of hours at this rate. And so here's the office hours that we have to work with. And then technology will pick up the rest. And so I'd love to say that I've created something to be able to dial it in. We just follow the numbers from what the market is doing and the big guys. We reverse engineer what they're doing, and we've created a system within our framework and the size of facilities that we buy and develop. And it's kind of plug and play.
I love that. I love it. That's awesome. Now I'm assuming it's not like a rental property where when a tenant applies, you got to pull their credit, check their background, call their previous landlord. You're looking for somebody that has a credit card, right?
Yeah, because if they don't pay us, we put a lock on it and then we sell their stuff. I mean, that's it. It's pretty simple.
Yeah. So there is no approval process, right?
And not necessarily. We do some background checks, and we also have cameras in place and obviously let them know that they can't be bringing anything in. But see, inherently within the facility, we don't, get the bad actors because, they've given us all their information. That's their unit. We're there. We've got cameras all over the place.
Right.
So, people, a lot of the questions that I get are, well, what about, if I'm storing dead bodies in meth labs and, all this stuff? And it's like, well, okay, so they're going to give us all their information. We've got their pictures, their fingerprints. We got videos all over the place. If they're hauling a dead body in and then they decide to leave it and not pay, we find it. Well, we know who left it there.
Right.
Or they're not going to run a meth lab in a facility with cameras and people there all the time, So, that bad element, just by the nature of the business, we don't worry about it and having the bad actors come in because it's just, they will go. They'll go to the abandoned apartments or the abandoned houses and they'll do all that stuff with nobody watching because we're always there and we're always watching.
There you go. That's awesome. So let's talk about some of those systems that you put in place and some of those. I mean, I love what you said a minute ago about the kiosk.
Yeah.
I've seen those before. I mean, that's phenomenal. So talk a little bit about some of the systems to help automate the management.
Yeah, so we're we're a pretty static industry. It's pretty straightforward. It's a simple, predictable business model. And so, one of the biggest splashes in the industry came back in 2006 with the advent of the kiosk. And so, we've been seeing kiosks coming into, and permeating our society at all levels. I mean, it started at the gas pump, by being able to pay at the pump. And then, to Redbox, to, hotels, airports, I mean, you name it.
And now Carvana.
I mean, yeah, you can literally, you and I both know as being road warriors, I could travel. I would not have to talk to somebody. I could fly down to see you, and I could book a ticket online. I can go to the airport and check in, through a kiosk, get on the plane, get off, go to the kiosk, get my rental car, come see you, And if there's no room at your place, I go stay at a hotel and check in with the kiosk there, and then do all backwards all over again, come home without ever having to come into contact with anyone. So, the kiosk is for these, low labor intensive type transactions like this. It's perfect. They insert their driver's license, barcode uploads all their information. So that's the approval process. We've got it. It takes their picture, we scan their fingerprint with the kiosk, and then they insert their credit card, and we got the payment. At that point, once they pick their unit from the map, if we have an electronic version of a door mechanism, it unlocks that door. Otherwise, we got a tab on it. They unlock that one. They go to their unit and put their stuff in, and then they can make their payments online through a website. They can go into the office if they want to. But the beauty of this, Larry, is when it's all tied into the property management system. So those kiosks really act as a manager.
Right.
And it ties into the property management system. So on the 6th of the month, which is when rent is late at all our facilities, the system locks everybody out. Their gate code does not work. They can't get into the facility if they have not paid, because that's tied into the property management system. And so then they have to make arrangements to pay online or via credit card. They can do it from their phone while they're there, or they can come into the office, and that's how we keep track of that. And so that was almost early on. That's almost outdated now, because since we have responsive websites, meaning they respond to whatever, if you're on an iPad, if you're on a phone, they match that.
Right.
But also an interactive website where we can do everything that I just mentioned that a kiosk does, with the exception of selling a lock. Those kiosks will sell a lock, and it can't accept a credit card, but yes, it can, because we do that with Apple Pay. And so now that kiosk has been replaced by this. And so when somebody's looking for a storage unit, they can find us, get on our site, they can rent a unit from our site, and then when they show up, they have the entire transaction has been completed, and they have their gate code in hand or a QR code to be able to get into the facility and to get into their unit. We're also seeing, one of the newest technologies available is that on the inside of the door, we have a locking mechanism that locks on the inside. And so that, through a QR code or another code, unlocks the door. They don't even have to have a lock on the outside or a key or anything else. And the beauty of this is that they get access to their unit, but then we do as well. And so instead of in the past, where we, at the 6th of the month, when somebody's late, we'd go and overlock their unit, put our lock on it. There's a place for locks. Now, automatically at the 6th of the month, anybody who hasn't paid, that lock is automatically locked from the inside electronically, without a property manager or anybody even stepping foot on site. So that's probably the greatest. And then along with any invoicing and communication that goes along with that, the move in, move out process, and how we manage it everywhere in between. Again, very, very little human interaction because it's just not needed and it's not necessary.
That is awesome. I love that. So somebody could pull up to the gate on the 7th of the month. They haven't paid their rent for that month. They pull up to the gate. They're locked out. They get on their phone. They pay on their phone. It sends them a QR code, one of those little fancy looking codes, and then they hold it up there, and then they get scanned in, and the door opens for them.
You got it. Yep. Or their gate code that they had, if it's a punch pad, automatically works now because they paid either or. Yep.
I love it, man. I love it. That's awesome.
Me both.
That's good stuff. That's good stuff. You could just about run a facility without anybody there, right?
There's many folks. There's a business model followed by several people, including one of the largest in the country. Happens to be located here in Indiana as well. It's a friendly competitor of mine. He's got 8,000 units across 7 states, and his whole business model from the beginning is no employees on site. So they're all run by a kiosk. And even before a kiosk, he's been doing this for 20 years. He had a ring down phone. If anybody on here is as old as Larry and I remembers what a ring down phone is, it means it's a red phone. It's like a bat phone. You pick it up and it automatically goes to his call center, and they would conduct the transaction and then go to the unit. But he replaced that with kiosks. And, he doesn't like tenants. He doesn't like toilets. He doesn't like trash, and he doesn't like employees. And so he has them all run, by a kiosk. So, yeah, we have a couple of our facilities that are run by kiosks, but our model is to generate more sales, more revenue. And so we do have people in the office that are doing the upsells on the retail and all those other ancillary income streams that I mentioned earlier. But, yeah, multiple ways of skinning the cat. Just depends on what, the site, the facility, and your business model.
That's great. That's great. So talk a little bit about the kind of financing that's available for self-storage, if you will.
Yeah, it's been fairly abundant. Self storage is obviously I'm biased, but I became biased before I was biased. When I began looking into financing for self storage back when I was in the tenant toilet business and my credit wasn't all that great and I was broke, I realized very quickly that self storage financing was pretty abundant, and that's because banks look at low loan default rates and the business sector and the model itself. And self-storage does extremely well during good times, like we're experiencing right now, where people have more money and they buy more stuff and they need a place to store their stuff.
Right.
But what happens with most real estate asset classes during a downturn is that the values go down. But in self-storage, well, the development financing stops, that speculative financing to build new self-storage facilities or build anything new, it just kind of stops. But the demand goes up for self-storage because now people are downsizing. Businesses are downsizing, and we actually see a steep increase in demand for self-storage during a recession.
Right.
At the same time, development is coming to a halt, or at least dramatically slowed. So therefore, the values go up, occupancy goes up, we get absorption, and so we've seen this in every economic cycle. Self-storage for the past 20 years has outpaced all other real estate asset classes for that reason, because we benefit from a recession. And so self-storage has the lowest loan default rate across all real estate asset classes. And so for that reason, banks love to have these things in their portfolio. It's safe. And the returns are high. It does well during good times. It does even better during a recession. And so the returns are much higher. And so for that reason, you can't really do this on the internet, but I think everybody's familiar with the term. I mean, you swing a dead cat on the internet and you find finance companies and banks that are wanting to finance self-storage. They're clamoring for it. They're out seeking it. So we don't have to chase money for self-storage. And then the same for private equity groups. These guys are bankers, essentially. They're seeing the same, they know the same metrics. They're seeing the same things. And so if you can't get a bank to fund your self-storage project, and if you can't find private equity to fund a self-storage deal, you're flat out not trying very hard, or you don't really have a deal. You got a crummy project on your hands that for whatever reason nobody wants. But when you truly have a deal that works, yeah, we have no shortage of people throwing money to want to invest with us in this asset class because it outperforms everything else, period.
That's great. That's great. When you bring in private investors, passive investors, what kind of returns are they looking at?
That's of course that depends. It depends on the economy and interest rates. But over the past several years, we've been looking at targeting a number on our projects of north of 20% internal rate of return. So trying to be in those mid 20s. And our goal area is always I don't want to have to beg for money, and we don't have to. But you know what? In order to get more people coming in, I want to provide returns that are greater than the CrowdStreets, the Fundrise, the Realty Moguls, some of the crowdfunding sites and people and even other people that are doing projects like ours.
Right.
And so while their returns are in the high teens, low 20s, I want to be in the mid 20s so I can get the project funded and get it done, perform for them, and then have them invest with me over and over and over again and have them not even look at anybody else. So that's the case over the past several years. Now we see interest rates creeping up a little bit, and inventory is a little more scarce. And across the entire, that private equity landscape in real estate period, we're seeing those IRRs come down a little bit now.
Right.
And so now we're shooting for right around 20-21%. We've been raising capital successfully at 19%, but that's because all those other folks that I just mentioned, their IRRs for their investors are now down 14-15%. So.
Right.
I'm shooting for 3 to 5 basis points above them, and that's all based upon the IRR that we return to our investors.
That's great. So if somebody invests, whatever, couple $100,000, I'm assuming you're working primarily with accredited investors or sophisticated
Correct.
investors.
Correct.
And when you do an offering, and so are they getting a monthly check, or is it like at the end of the 5 years their average return was 20% per year?
Yeah, if they get the big pop in the back end. So if it's an existing facility that we're turning around, as soon as it begins cash flowing, then usually 4 to 5 months after that, we build a cushion, then we start the distributions. And so that could be from 6 months to 12 from the time we take over a facility. In our development projects, that takes a little bit longer, and that could be 2 to 3 years before the thing gets entitled, zoned, built, and then we start, reaching the break even and then over into the positive cash flow section of the holding period. So most of our folks are not investing for cash flow plays. They're investing for building wealth because they'll start getting cash flow in years 2, 3, 4, and then all of a sudden it'll start to kick up in year 5. But that's the point that then we've stabilized, we sell, and then boom, that comes the big pop. Which, when you calculate IRR over 5 years, the lion's share of that, the majority of their profits are at the sale of that property. And in some of these cases, we may have a construction loan, like a project that we're working on right now. There's a construction loan, which in 2.5 years, we'll refinance that and recapture some of those profits and pay our investors at that point. And then again, they get the balance of that, another big pop on the back end.
Right. That's awesome. And Scott, this has been some great information, good, solid content. And man, I just love it. If somebody out there wants to reach out to you and learn more, I know you teach this and you have some events as well. And so how would people get in touch with you?
Yeah, just about everything that we do and anything anybody wants to know is at our site at selfstorageinvesting.com. selfstorageinvesting.com. So there's some free resources there, some videos, and then listings of our events. We talk about our charities and our house builds where we take folks down with us as well, which is a big focus of ours at this point, and everything in between. So that's where it all happens.
That's awesome. Man, I really appreciate you sharing all this. This has been some awesome information. It went a little over from what we normally do, but it's great content, great information. And thanks so much for sharing that. It's been awesome.
Yeah, well, thanks for having me, Larry. It's good to catch up with you again as well.
Awesome. Thanks a lot. Take care.
All right, you do the same.